Welcome to Canada Money, where we make your cash hustle harder than a beaver on a double fueled dam building spree. We're diving into the wild world of mutual funds, those financial timbits promising to grow your savings faster than your buddy's can't lose crypto hustle. In simple words, mutual funds pool money from many investors to buy a mix of stocks, bonds, or other assets, managed by pros to spread risk. Global mutual fund assets hit $71 trillion in 2024, enough to fill a hockey rink. Whether you're saving for a Toronto condo, a Banff ski trip, or an emergency poutine stash, here are 7 golden rules to check before investing. Buckle up, get curious, and keep your wallet from wiping out on the global market ice. What's your financial dream? Retirement by 2050? Cash for weekly Timmy's runs? Or savings safer than a puck in a shutout? Risk tolerance is key. Can you laugh off market dips like a bumpy ride on the Trans-Canada Highway? Or need calm like a sunny day on PEI's beaches? The 2024 HSBC survey says 58% of 25 to 34-year-olds prefer low-risk options, but younger folks chase equity funds for growth. Equity funds, stock-heavy, can swing 20 to 30% yearly. Thrilling. Debt or balanced funds stay chill with 5 to 10% volatility. Match your fund to your timeline, short for a new snowmobile, long for retirement, and your cool-headedness when markets get grumpier than a Canadian blizzard. Take a risk quiz from banks like RBC, or use apps like Wealthsimple to gauge your comfort with market swings. Past performance isn't a magic puck, but it's like checking a hockey team's streak before betting on the Stanley Cup. Look at 3, 5, or 10-year returns against a benchmark like the MSCI World Index, averaging 8.1% annually from 2015 to 2024. Is the fund consistently scoring, or a one-season wonder? Top global equity funds like Vanguard's Global Equity posted 9 to 11% average returns over a decade, beating benchmarks. Steady gains beat wild swings like a fund soaring 25% then crashing 15%. Check platforms like Morningstar, but don't swoon over numbers. Markets shift faster than a Calgary rush hour. Look for risk-adjusted returns, like Sharpe ratio, to see if gains justify the ups and downs. Mutual funds charge an expense ratio, yearly fees of 0.5 to 2% for managing your money. This sneaky cost nibbles returns like a squirrel on a donut. In Canada, management expense ratios, MERs, include taxes and operating costs. Check fund fact sheets for the full breakdown. A low 0.2% fee on a passive index fund, like BlackRock's MSCI World Tracker, saves big. For example, $10,000 at 7% returns with a 0.5% fee grows to $38,000 in 20 years. A 2% fee cuts it to $29,000. Ouch! Active funds with stock-picking flair charge 1 to 2%, so they better shine like maple syrup. Globally, 65% of fund assets are in high-fee active funds. Check the prospectus to balance costs and performance. The fund manager is your money's coach, and their track record counts. How long have they skated and do they nail it? Active managers pick stocks to beat markets, charging more, while passive funds track indexes like the S&P TSX for less. Stars at Fidelity or RBC outpace benchmarks by 2-3% in great years. Long-tenured managers bring stability. Even a hockey star like Sidney Crosby misses shots, so ensure their style, growth or steady, suits you. Check their bio on the fund site and pick a vibe matching your risk appetite, thrill seeker, or safe player. Do research if the manager has navigated past market crashes, like 2008 or 2020, to assess their skill under pressure. A fund's asset allocation is like a poutine plate: stocks, bonds, cash, or quirky bits like real estate. Stock-heavy funds chase big gains but swing like a moose on skates. Bond-heavy funds are cozy like a Muskoka campfire, offering 3 to 5% returns. Diversifying across sectors or countries cushions crashes. A tech fund might have jumped 25% in 2020 but tanked 15% in 2022, while Global Balanced Fund held 6 to 8%. Balanced funds held 40% of global assets in 2024. Check the fund's docs to match your risk and diversify from your meme coin splurge. Canadian funds often include domestic giants like Shopify or Royal Bank, but global exposure reduces reliance on our resource-heavy market. Some funds charge a load, 3 to 5% fees when buying or selling, like a cover at a sketchy Yonge Street club. No-load funds skip this, delighting frugal Canadians. About 25% of global funds are load funds sold by advisors grabbing commissions. A $10,000 investment with a 5% front load starts at $9,500. Yikes! Some waive fees after 5 to 7 years, but no-load funds with high expense ratios can still bite. Crunch numbers and compare costs to save for an extra skate in Whistler. Ask advisors if they're paid by commissions to spot bias, and consider DIY platforms for no-load options. A fund's size, assets under management, is like your snowmobile's size. Too small, under $100 million, and it might stall, with 4% of funds closing yearly. Too big, multi-billion, and it's like parking a Zamboni in Vancouver. Clunky, especially for niche small-cap stocks. Mid-sized funds, $500 million to $2 billion, balance agility and stability. Big funds like BlackRock's Global Dividend with more than $15 billion suit broad markets. Smaller ones like Dynamics Small Business Fund at $150 million nail targeted plays. Check AUM on the fund's site to keep your cash nimble as a curling stone on ice. Pro tip, smaller funds may have higher fees to cover costs, so compare expense ratios alongside AUM for the full picture. Let's wrap it up. That's 7 things to snoop before a mutual fund snags your cash. Investing is like picking a perfect toque. Fit your style, keep you comfy, don't break the bank. Fun fact, diversified investors globally saved 15 to 20% more over 10 years, per HSBC's 2024 study. Start small with automatic contributions to build investing habits. Ready to start? Comment, like, and subscribe for more money adventures. Keep your cash safe and stay curious as a kid at a Calgary Stampede. Peace out.